Hi, everybody. I'm Ron Mazurski, the founder and board member of NYPAY and a partner in Pagility Advisors. I'd like to welcome you to NYPAY's Hot Topics, Insights from Key Industry Insiders events. You're going to hear NYPAY presents monthly events, blending an educational experience with networking within the financial services industry. We are a community of senior execs and innovators that cover payments, banking, and fintech. Today, we're going to start off with this expert panel that you'll hear about in a minute. And we'll follow that up with a networking session where you can meet panelists and other attendees. Just a few administrative items for everybody. First of all, if you have any questions to ask anybody, please type them into the chat feature. And I'll be able to read them off later to the folks on the panel to be able to answer. If you want to be able to connect with others after the call, I'm going to ask for you to put your name and email or your LinkedIn information into that chat feature and then save it, and you'll be able to. And I usually save it a couple of times during the call, so that whoever has additional questions or additional info that they've put in, you'll be able to see their contact info. Now, anybody that hasn't turned off your video yet, please turn off your video now. Please also make sure your microphone is muted. That way we keep the attention on the three panelists and the moderator. I want to thank our sponsors. That's Davis Wright Tremaine and Further Advisory. And what I want to do now is introduce you to our moderator. It's Ed Dellheim of MorganFranklin and a member of our events committee. And he's going to introduce our panelists and introduce himself. Ed, take it away. Thank you.
Thanks, Ron. Appreciate that. Really excited to be here with all of you and facilitate this month's roundtable. As Ron mentioned, it's hot topics and insights from key industry leaders, and the panel we assembled is impressive and definitely hits that mark. So for introductions, we are joined by Dan Wheeler. He is the founder and CEO of Financial Technology Bank, a past trust company CEO and founder, and serves as director of several financial technology startups. He served as the general counsel of a cryptocurrency lender, advises on blockchain projects, received his degree, law degree from NYU, and advises clients on a whole range of regulatory initiatives. Welcome, Dan. Thanks for being here. Next up, in no particular order, Austin Campbell is joining us. Austin's the founder and managing partner of Zero Knowledge Consulting and an adjunct professor at Columbia Business School. Previously, he ran a stablecoin platform and portfolio management at Paxos, as well as was the chief risk officer for Paxos National Trust. So he's managed fixed income trading desks at JP Morgan and Citi, covering over $100 billion in cash derivatives, and has been the portfolio manager and structurer at Stone Ridge, a parent of NYPAY. And last but not least, Steve Wasserman. Steve's an entrepreneur, a serial entrepreneur through two successful startups and acquisition exits, including IPP, a fintech company that enabled financially inclusive walk-in bill payment, plus prepaid and debit card solutions. IPP ended up being a major part of a PayPal acquisition for over $300 million. He then founded VMents based on patented tokenized deposits and enterprise digital banking platform, IP, and currently is consulting Photon Commerce on technology architecture, helping clients and partners leverage AI software to extract and automate data from financial transactions. He is on many different industry groups, including leadership positions with U.S. Faster Payments Council, Fed Improvements Facilitated Business Payments Coalition, X9, ISO 20022 Market Practices Forum, the FedNow community, and the FPC Board Advisory Group. He gave me a tongue twister there, but I hope I got through it just fine. So why don't we go ahead and, without delay, dive right in. We've got quite a number of topics we want to cover in a really short period of time. And the first one is payments modernization. Payments modernization, big topic, worthy of its own hour. So we're going to focus more on just sort of the practical and tactical aspects, thinking about the next 12, 18 months. And I'd like to maybe go to you, Steve, first. What we've seen recently, especially, is a lot of players are sort of taking the path of least resistance and sort of doing the minimum they need in order to comply as they modernize. They recognize it, and at the same time, it's sort of just doing enough to sort of meet that next milestone rather than charge ahead full bore. First, do you see that as well, and do you think that's going to remain the case in 2024? Any prognostication as far as that? Are organizations looking to accelerate their journey there?
Well, I do feel that it has been taking an approach for many decades, taking an approach of just do the minimum what you can to satisfy requirements as things have been changing. But things are changing more rapidly now, and there are new competitors with new modern platforms. Many of the legacy players have legacy platforms, some of which involve COBOL, of which there are not as many, and either existing or willing to maintain those types of systems. Those systems are also relatively inflexible compared to more modern development and infrastructure platforms. So they have a bigger task to take than they're like a big ship versus a new fintech that starts up and they could, be a speedboat that can go around them. So many of them started, partnering with fintechs and in some cases acquiring fintechs to help them with their journeys. But they realize they need to, because there's demand for to be more competitive with other non-bank services. PayPal just announced today its first look, very exciting things coming from them. But you have other major players that have lots of different things. You have crypto, people are starting to use that, but it's still a little bit of the Wild West and not properly regulated yet. So these are some of the things that banks are learning from. And there's a lot of things that they can do to try to move forward, but I think it's accelerating because they have to.
I think that's a great frame up. Thanks for that, Steve, because it touched on a number of the different components that really go into when we talk about the modernization pathway that are in play and under consideration. And I was thinking maybe, by the way, I can't get COBOL out of my mind now that you brought it up. I think we all have had our fair share of nightmares with that, but if it's here to stay, I guess we should start embracing it. Dan, maybe bringing you into this topic, from your vantage point as a founder and innovator, and you're a counsel to those players that Steve just mentioned, banks, fintechs, non-bank lenders. Are there any particular components of modernization, as Steve did a great job of outlining, that clearly carry maybe a higher ROI than others, that might help us think in terms of prioritization? If we're starting to realize, okay, I do need to go faster, what are the most important things for second priorities for me? And then second question, maybe putting on your other hat that you wear, helping clients, recognize and avoid or mitigate risks. Where would the higher risks reside, where maybe it is better to do a wait and see?
Sure. So priorities and especially priorities in minimizing risk. I see a lot of clients, startups, and even mature depository institutions get their priorities wrong. When I was working for a crypto company that moved fast, the things that it was good about, as many crypto companies are, is very innovative business models, cutting edge technology, but really not getting first things first, not triaging correctly. I, I see some depositories doing things correctly. And here's what I would suggest as a triage or a ranking of priorities. In financial services, whether you're a bank or a fintech or crypto, you have to have a foundation. You have to get three things right. One is information security, data and information security. You have to have an AML, anti-money laundering program that's robust, that works and is documented. And you've really got to be on top of fraud prevention, preventing fraud. The crypto company I was a part of stumbled in each of those regards, right? The number of hacks that have occurred over the last 5 years in the crypto industry, especially hacks, thefts, penetrations into the hundreds of millions, perhaps billions of dollars worth. You have to get that right first before you start building a business. And I see client this week. I'm seeing clients attempting a range of business models, like a new middleware company, right, that wants to be the next Synapse. Really misunderstanding what it means to build an information security program. It is not, right, grabbing someone else's a printout of their information security policy and changing the name and then saying that you have a program, right? You have a policy that you haven't even read yet. It might be a framework, but it is not a program. I see banks that they can outsource all that to their core processor, and that can work if you're a very basic community bank and you don't envision doing anything innovative. That can work. But if you're doing something innovative, then you really need to take a rigorous approach to information security. I can pause there in terms of priorities, but those would be the categories of priorities.
They're great, Dan. And what resonates with me is talking about how how it's not just a cut and paste exercise, and each one of the organizations has to think about where they are today and who they are, who they want to be, and how that all fits together in order to come up with the right solution for them. And that, I think you're absolutely right, does impact the prioritization. Maybe Austin, giving you a chance, and got another minute or two on this topic to weigh in here, because I know you come at this really understanding both crypto and financial markets well, and lean in on the more innovative aspects of those things. Any thoughts you'd like to add?
Yeah, I would say for me, one of the things I observe on that front is you're also going to see this pick up specifically where the marginal benefit is probably the largest, right? So a little bit like Africa skipping landlines and going straight to mobile phones. I would expect some of the places where you're going to see implementations of like 24/7 real-time payments using something like a blockchain pickup are probably places that had terrible infrastructure for payments in the first place. When it's already decently adequate, the marginal benefit of either building all of the systems that Dan just talked about or taking the risk to run something that is a little jankier as you scale doesn't make sense, right? When it's a massive upgrade to the local system and probably better in all ways, if you can get it running, that makes more sense. So I think some of this will also be driven by marginal benefit in that context, and some of it will be driven, honestly, to some extent by sort of this inverse problem we have in regulation, where some of the most sophisticated economies like the US are also having the hardest time passing legislation that works. And you'll have other places that are smaller that have just moved faster. So you can do it, without the important factor of going to jail for it.
Absolutely. And we're going to be touching on a little bit of that regulatory and some of the other challenges a little bit later on. You mentioned something early in your remarks that made me think in terms of also the sort of in-source, outsource partnership questions around how you should think about what you need to own, what you should own, versus what you can rely upon others to perform for you. So maybe shifting gears and bridging into our next hot topic, banking as a service. That industry seems to be at a crossroads. And maybe back to you, Dan. We see the number of players that are getting serious about BaaS sort of leveling out possibly. Do you see that the number of players and organizations that are trying to really forge new ground when it comes to BaaS are we consolidating around, and so there'll be fewer players that are larger? Are we still growing and there's a lot of innovation to be found in that space? I'm curious to know what your thoughts are for that near and maybe medium term window of time.
Well, I think BaaS is the most interesting area in banking, banking as a service, or BaaS. It's where the most, I think, growth possibilities lie for banks. The path to scaling and to profit growth, I think, are the greatest. So the promise is significant. I'm seeing more banks consider it. So there's a whole wide range of surprising banks in surprising corners of the country, tiny banks, commonly very small banks, thinking about it now. So there's a lot of banks that it's on their mind. I and probably people who are in this space, we have these spreadsheets where we're trying to track banks that are in this space, and we're trying to track what their appetite is, and it's a moving target. Every bank's a moving target. And the reason it's very much in flux is there's some very, very publicized examples of banks that have been in this space and have gotten their hands slapped, enforcement actions. They've been sort of boxed out of this business, which which creates a lot of fear. And some of that fear is rational, some of the fear is not rational. But there's a great deal of interest in the space, and all of them, if a bank has the window open and they've hung the BaaS sign out the window, they have a line around the block. There is more business and more demand than the current roster of banks can possibly meet. It's a waiting line, and a lot of the what I see there is jockeying to get in position. But there is no magic here, frankly, or any mystery. The regulators have been incredibly explicit.
I think Dan may have frozen, unfortunately, right at a fantastic point I'm sure he was going to make. They're all great. Dan, we lost you there for a moment at the end. Steve, sort of picking up on the things we did here from Dan, I'm just curious if you have some thoughts around what it does mean in terms of opportunity and challenges for the fintechs and corporates that want to embed BaaS into their products. Where do you see, do you see any specific use cases that really are the ones that present the strongest opportunity for those innovative startup dynamic players?
Well, I could talk a little bit about use cases, but before that, Dan touched upon, the bank offering BaaS, or a fintech offering on behalf of a bank or banks. But if you think about the fintechs, the corporates who want to use those services and embed those things into their products and services, there's a few things that I had some thoughts about, and that included there's kind of a lack of standards, especially here in the US, because it's a market-driven economy here. Whereas in some countries, standards are like in the UK and Europe, you have open banking standards that everybody can follow. And otherwise, you're trying to work with different banking as a service input and output, specific implementations. Even though they all may follow an open API general standard and guidelines, they still may be implementing those standards a little differently from each other. So that serves as a challenge to the fintechs and the corporates. The opportunity is somehow for the industry to come together and establish a set of standards that, or at least some commonality more, to enable more organizations to get on board with banking as a service. And in order to implement banking as a service within an organization, because there are variations now and perhaps future variations as I have new versions of the software, or I may want to switch to another party. I want to insulate my application software from any external banking as a service APIs I may want to use. And it's just a kind of an architecture approach to having your own general APIs that you integrate and interface with your application software and user experiences and so forth, from that interface with the corresponding banking as a service API functions that you integrate them with, so that when those versions change and all that, I don't have to change my application. If I have embedded too much detail of a specific banking as a service API into my software, and now that changes, I have to change it kind of, in all the places it may touch in my application software. If I insulate it, I created a layer, then I'm able to avoid those pitfalls. And the other thing, when I'm defining my internal APIs, I want to design them for a broad use that I may not implement. We talked earlier about implementing things. They did the minimum, but you should first design for the maximum, but implement the minimum a piece at a time. Where when you want to implement the next step, it's already designed in, or at least your design is designed to be flexible. So using technology, internal technologies, you want to use JSON and XML types of formats that allow flexibility for things being added and changed without having to redesign things on what's using it. So those are some things. As far as use cases, I've been seeing that use cases, a lot of organizations, corporates might use it to allow their employees to get debit cards so that they can pay them with. That could also be the case with merchants and other and billers, where they can. That's the other. No, take it back. I want people to be able to send money to them. So the employee case was a better use case, but there are other cases where I'm offering debit cards or opening up accounts on behalf of my customers and so forth, so they can pay me. And those are benefits to the banks, especially if I'm getting more money putting through the banking partners that are providing that banking as a service. Those are great benefits to them.
I think that makes a ton of sense, and the idea of like having the longer term, the full big picture, all that in mind, to then know how to do those bare minimums. But tying that what you were just speaking to around the technical challenges, the things that have to be created and solved for, as well as the ecosystem itself of the players. And then Dan, which you were talking about, in terms of some of these other forces at play. I'm using it as I'm using that recap as a wind up to ask a professorial question to you, Austin, and that is, do you see the current issues and challenges in the BaaS and as an industry, as around regulatory compliance, data security, technology integration, et cetera. Do you see that as structural? That it's something that is just that is what it is needs to be solved for, and it will always need to be continue to be worked on? Or so in other words, are these persistent challenges that are just endemic to the space, or is this just, you know, normal growing pains for a young industry?
I mean, I'm going to give you the most professorial answer ever to say it depends on some of both. Which is to say, if you think about something like data security, right, you have a model in your mind for that. That is ultimately an ongoing and permanent contest between bad actors and the people attempting to achieve security, because for every improvement that you have on the defense side, somebody will find a new way to play offense and vice versa. There is no way out of that cycle so long as information has value and people are willing to try to compromise things to get a hold of that value. That's just how the world works. So that is an ongoing struggle that will continue for all time. The question is just, where is the balance of powers currently, and what tools do we have to fight, you know, essentially on the good side to try to prevent some of these issues? At a more macro level, my personal view on what's going on with the banking as a service space is, I think from an industry standpoint, and this applies to both the tech industry and the banking industry, and a regulatory standpoint, we're at one of those points where we need to zoom out and start asking some first principles questions, because by continuing to apply old frameworks to things, we may be creating more problems than we solve. So a good example of that is there's a question in the chat about who should own ERM, essentially. And the answer to that actually is that really depends on the problem, right? The regulators currently in the banking space are trying to push out TPRM type policies to make the banks do both more due diligence and own more of the process from an ERM standpoint. But being totally blunt with you, having worked in a number of banks, they often don't have first-class tech people, and it can be hard for them to retain them in certain areas. So you're also running the risk of having a whole bunch of individual banks build cottage industry programs to do this with less than great people, while the bad actors are actually sophisticated and more skilled at going to individually compromise each one of them, because they'll find the weak ones and break them first. Maybe that should be more centralized for some of these functions, but then it leaves the direct remit of the banking regulators, so they get scared about it, so they want it back, because it is relevant to bank security. So this is what I mean by a first principles problem, is as banking and technology are slowly converging to just one thing, in a lot of these applications, we need to rethink some of the core principles of who's regulating what, why, and where are the correct people to own this risk.
Go ahead, Dan.
Hopefully you can hear me better now. I ditched the headphones.
Oh, we can hear you great. Yeah. Thank you.
You may not have been able to hear. I was trying to make the point earlier that in the world of banking as a service, it comes back to what is the regulator's expectation, right? For a bank to swim in the BaaS swim lane, what are the rules of the road? Because if they don't follow the rules of the road, the next exam, the bank examiner, the bank will be told, stop doing what you're doing. And the reason I see this area as pretty formulaic. Like, the regulators have written a very detailed roadmap in the form of their June 2023 interagency guidance around this. It requires detailed checklist and a lot of work, substantial diligence, and, you know, follow through and monitoring. But the framework is laid out there. This is not an area where it's guesswork, where we have to wait for an enforcement action to know what the rule is. The rules are super clear. The banks that get their hands slapped in this area haven't been paying attention. The level of oversight that a bank must have over its partners in a bank program. Let's take a payments partnership. The most common use case I see out there for BaaS is you've got a payments company that needs an FBO account. like a pooled settlement account that's titled in the name of the bank for the benefit of the fintech, right? That's the for benefit of is where FBO comes from. That's what, in my limited data set, that's 80% of the needs for BaaS. You need a bank account with a particular titling. Not a hard thing for a bank to do, right? You just type in the name of the account, it's on its ledger, the core processor does the rest. From a technology perspective, you're done, but you're definitely not done under the regulatory expectations, right? You've got to make sure that your fintech has in place detailed AML program, a detailed information security program, compliance policies tailored to what they're doing. And it's very detailed, but it's not magic. It's actually quite formulaic, and it's just that most banks have not been doing the work. The ones that tiptoe into it neglect to do it the right way. They neglect to take the time necessary. And a lot of banks, they're in queue, hoping and praying for a bank partnership. They also haven't done the homework. So they show up unprepared, and the bank takes one look and says, there's gaps all over the place. Go back, fill your gaps, and they're at the end of the line again. That's what I'm seeing.
What I'm picking up on here is it connects to me with Austin's comment about sort of there's a gap within a lot of the financial institutions, larger ones especially, in terms of having some of that deeper skill set in order to actually accomplish some of these matters. And in my mind, right or wrong, it bridges. And in fact, this getting the guidance from a regulatory standpoint, also both those things are conspiring in my mind to bridge into the elephant in the room hot topic that we haven't talked about yet. And I know we don't have a ton of time to go into the details, but that's AI, right? So maybe I'll turn to you, Steve. And I hate to do this to you twice in a row, but again, I'm thinking in terms of like everybody's hearing about AI. It's the topic that you can't get away from, and at the same time, it feels like this year is a year to maybe replace novelty and exploration with some pragmatism. And I wanted to know if you had some thoughts on, again, prioritizing the use cases for AI, and you can use AI, I think, to try to improve any one of the different things that we've talked about already on this call, all the different areas that need to be solved for. I'm just throwing a wide open question to you. What do you think are the prioritized AI use cases?
Well, I could talk about the use cases, but I will also talk about, I'm involved in a company, Photon Commerce, that is focused on one type of AI. You can call it interpretive or extractive AI. We work with documents that are financial transaction documents, such as bills, invoices, checks, B2B remittance detail on checks, purchase receipts, freight and shipping documents, POs, contracts, and doing a whole bunch of different things with any of those and others, because we use an AI to interpret the information off of it contextually, as opposed to how it's been done in the past with previous OCR, optical character recognition software. And we're using that in a variety of ways. We could use the data and help an organization with some remote process automation, which is a type of AI itself, or robotic process automation. We help improve user experiences so that the data that's extracted off of a document maybe can help initiate a payment transaction. So that's a good thing. And one of our things in our service, it's not just having the AI, but we have a human in the loop option that can actually provide an additional service to improve the accuracy of what information was captured off of a transaction, and using that information then to have our AI continue to learn to be even better. So it keeps improving itself, with some human assistance in there. Then we use that data perhaps also to do certain business rules. So that's doing things like fraud detection and error detection, maybe some business intelligence in there that we're using that for. And an interesting use case for the information is to have the information we capture off of, let's say, an invoice. We can capture, we know who the supplier and the buyer are. We can read that information right off the invoice, and we could set that up as a directory information that could builds up intelligence and other information we can relate to it as well. But when we read the line item information, there was an interesting thing in today's PayPal's First Look. They talk about the line item detail on the purchase receipts and the information you could do with that. That's a real value, and it's just endless, the capabilities of what you can do with that. Then the last part is, again, now using all the collected information you've collected internally and using generative AI to be able to summarize the data patterns, come out with some reporting capabilities off of it, maybe use it help for marketing communications. So it's generating things for us. So I kind of started from what I talked about there for what we do at Photon Commerce, but you also asked about use cases for in general, and for banks and other organizations using AI. We want to be able to automate back-end processing things, and we don't want it to take over people's jobs, but we want to make it so that they can become more analytic, and things are operated for them. And in the case of a bank, we want to use it for compliance capabilities, reconciliation, reporting. And actually, it's not just in a bank. It's corporations have to do the same thing too. Certainly fintechs as well. I talked about improved user experiences. The data can be auto-filled. Maybe I have data, I can look back in their history and pull information to help them either suggest or fill in previously used values. Find associated information that can help them with suggestions, identify duplicate transactions that maybe they tried to pay something twice, and then other outliers that we may determine. It's like, why are you paying $10,000 when you normally pay this bill for $1,000? So this is examples. But a big one we've talked about this a few times. AI is key to doing fraud management. You can guarantee that the bad actors are using AI to help them, uncover the information that they need to work their way in your world. We need to do the same thing on the other side. So it's kind of an AI war between the fraudsters and the people who are trying to keep them out. So other use cases are marketing and sales. If you go into ChatGPT, you'll say, draft an email for me, or write this report for me, or summarize the history of something for me. So I could use that for various marketing communications. And let's not forget customer service. We hate those automated attendants, but AI can make them better.
So you've done a great job of actually illuminating very, very well. I appreciate that. The sort of the wind up to that question, which is there are a plethora of applications that we can imagine, and I know we're starting to probe and test and pilot out. Recent surveys are showing that most bank executives are expecting to see an impact to their business in 2024 from AI. But when you double click on that, I haven't seen a lot that answers this question. And I'm not sure, Austin, Dan, who wants to take this, but where do you see actual tangible impact taking place as a result of AI, and then where would we expect that to be felt the most? Because it's a hammer looking for a nail in a lot of cases, to use an old phrase. So where's the juice, I guess?
Well, I'll hop in and say there's two that I see. One, Steve unfortunately brought up, which is, hilariously true. One of the best indicators of the long-term use of a technology is that the first people who start using it are criminals. So this is going to cause people to have to rethink some of their security procedures, because when you can get a phone call from a customer that sounds exactly like that customer and knows all of their info, but guys, it's an AI, you definitely have some compromise problems as it relates to how you've been doing InfoSec in the past. I've seen some very sophisticated spear phishing type attempts out of this already, being in the crypto space. So that is going to be very real, and it's going to be something people have to grapple with. Number two, having been in a CRO seat and thinking about some of the things that really gave me heartburn, AI being used by people for error catching is going to be incredibly powerful. I would suggest the AI alone will not do a good job of this, but AI plus human will be significantly better than either one of those alone when it comes to error catching, because simple things like, did a trader fat finger this? Does this payment make sense? Is it going to the right place? Is this how we've done it before? Things very small, like just screwing up your confirm and, essentially having to go back and talk to people, to things very large, like say the Revlon incident at Citi, all could be prevented with that sort of technology. And when you leave it only in the hands of humans, it is a matter of time until they screw up. When you leave it only in the hands of AI, it doesn't really understand context in a lot of cases. It has its own problems. Risk management combining both is one of the earliest use cases, because you don't have to let it drive alone, but it adds a huge amount of value.
I love this conversation, and again, this is one of those topics that deserves and will have a full hour, maybe multiple times this year. We've got a couple more topics that we wanted to touch on, and I'm cognizant of the time, so I'm going to maybe do these a little bit more rapid fire. The topics are CBDC and digital assets and real-time payments. We've talked a little bit on these, in passing. Dan, there's growing resistance in the U.S. to CBDC, and it seems like there could be a significant impact on the direction it goes depending on the results of the election. And so I'm curious what you're advising organizations to do this year, given that uncertainty.
Well, I have not seen CBDC affect any of my clients or advised companies' business plans. It's too nascent at this point. The only people it seems to be affecting their business are the consultants, right, who are being paid by the Fed or by somebody to promote CBDC or run pilot programs. So I'm not seeing a direct impact on anybody's business. I am advising anyone who will listen to express their opposition to the CBDC. Not everyone takes me seriously. I had the opportunity. I was at a conference and I had that 30-second interaction with Peter Thiel. He's a very smart guy. He will not remember this. He doesn't know me from Adam. But this was early last year, so like a full year ago. I said, Peter, like, what do you think about the CBDC? Isn't that a terrible, dangerous thing? And his response, Peter's a known libertarian and kind of an independent thinker, despite running surveillance companies. And his response was, it's so technologically impossible. He wasn't worried because he didn't think the Fed had any hope of being able to launch this as a functional technology system. I shared that. The Fed is, it's facilitated more fraud than anybody has. And the federal government, of course, was defrauded hundreds of billions of dollars during just the COVID, era. So as a organization, yes, I think they have a weak institutional capability for a technology like this. As I read their initial paper, whenever that came out, at least two plus years ago, from the Fed itself, a paper that comes from an institution has a lot of people that help write it or that weigh in on it. And as I read that, it definitely reflected an internal push and pull, a great deal of internal fear that A, they didn't have any legal authority to do this, that it would be so disruptive to banking and to the payments industry that, it was like detonating a bomb and hoping that nothing would happen. So I think the Fed itself is conflicted, honestly, internally. I mean, I think there's a number of serious strikes against it. You mentioned, Ed, that there's a lot of political resistance to it. And I think I heard even Austin say that because it's unwanted and distasteful as a political matter, right? The value of the CBDC, right? It would trade at a discount to quote real money, right?
Mhm.
I think that's one of the strongest because people hate it, they don't want it. It would tend to drive the de-dollarization process that the country should worry about, right? If the rest of the world moves off of the dollar and the dollar stops being the world's reserve currency, that's going to be painful for the United States. It might be a good thing for the world, but it's going to be painful for the United States. Anyway, so if policymakers want to prevent de-dollarization, they really shouldn't be talking about a CBDC at all, because that'll devalue the dollar,
Mm.
in my opinion. Anyway, there are a few positive points, I guess, in favor of a CBDC. It would certainly be the ultimate window for law enforcement, right? Now, the federal government through the Fed would have a window into every single financial transaction that occurs in the economy. So yes, it would definitely help law enforcement, but it would render us having zero privacy, right?
Yeah.
Everything you do, the allowance you give your kids, the donation you put in, in a church, it's all known. And that, I think, makes a lot of people uncomfortable. So I hope it doesn't go anywhere. I don't think that's just why I don't see any of my clients grappling with it as a real future risk.
Got it. And Austin, picking up on what Dan's putting out there, just playing the counterfactual, assuming the U.S. does go forward, do we have lessons learned yet from the countries that have already adopted CBDC, Bahamas, Nigeria, et cetera? Like, are there some things that they've done as the vanguard that can help us find a path there?
I do think so, and I think this is informing some of Dan's commentary because, my first question to people when they say this is, what do you mean by CBDC? Because people say that word with very low specificity, and then you really have to drill down. I would say when you look at the current test projects that are out in the wild, right, Bahamas, Nigeria, China, right, you ask how have these done, there have been kind of two types of reactions to them. One, nobody cares, nobody uses it. I would say the Bahamas is a great example of that, right? Or two, it causes all kinds of problems and people get very angry about it, where Nigeria is probably a good example of that. And what I would say as a general statement is if you want to replace your current money with a CBDC, then you need to make it work like your current money if you don't want things to break. Which is to say, if you could somehow create a digital, non-trackable, bearer possession version of the dollar, then that probably works just fine. But the moment you start doing something else, it is not money as people think of it in their head. If it's programmable, if it's revocable, if it's completely traceable, because let's be honest, there are legitimate reasons for privacy as well as illicit uses, then it is less valuable, right? And this is the source of Dan's comment, because I've said this elsewhere. If the CBDC works that way and you have a dollar bill that's a physical dollar bill, the CBDC should trade at a discount to the dollar bill because it has less functionality and more interdiction possible. So what this leads to in the US is there's probably two good models of a CBDC that would be helpful, and neither of them are the ones people are really talking about, right? Number one is what I just said, which is a literal physical dollar replacement that is a bearer non-traceable instrument. I'd be fine with that, but that's not what people mean when they talk about it. The other one is basically just a back-end upgrade to the Fed system where it's purely wholesale money, right? If you're only using it to face the banks and it's what you're using to track reserves and things like that, maybe there are benefits with it. You certainly don't need a blockchain, though. You can just use a private ledger. But you could create some sort of like, central bank digital currency that would work fine for wholesale use cases only. If you want a retail CBDC, though, if you don't do what I said in the first case, you are now down the rabbit hole of like the complex stance of we need something that is like legally permissible in the United States, would probably be authorized by Congress, and turns the Federal Reserve into the largest retail bank in America. Like there's a lot of hair on this.
I like that. I like that phrase. I'm gonna skip over a couple other questions, just paying attention to the clock here, and I want to make sure we do touch upon real-time payments a little bit more. So Steve, there was a study recently that showed that only 18-20% of FIs were participating in real-time payments, and the question is, why the hesitation, and is it somehow related to the need to adopt ISO 20022 as a precursor to institutions maybe jumping in?
So this is a really good question. First of all, if you look back, if people are familiar with when ACH first came to be, it didn't happen overnight, and it didn't happen over a couple of years. It happened over a long period of time, and it's still growing. And so, real-time payments, as they're introduced, you had the RTP network that came live, back in 2017, but FedNow just came live back, last July. And when RTP came alive with the banks that they implemented, and they're up to some number of hundred banks, I think 300 or 400, that those banks are include some of the biggest banks in the US, and they cover like 75-80% of all the accounts. So we, even though we have a small percentage of the 10,000 plus banks in the US, we have the majority of the accounts covered. And that was one of the reasons that the Fed established FedNow, is to help with the smaller institutions that had some issues with operating under a system controlled by the big banks, which the clearinghouse is somewhat, the board is controlled by those organizations. So the FedNow, having just started in July, I just saw recently, I think they were up to almost 1,000 banks, but still a much smaller percentage of the total accounts that it reaches. And that's pretty short time. So we're going to see how that grows. And the key to what gets implemented for real-time payments is the use cases. And it's all about the use cases, I like to say. When you have a use case, when you need something paid instantly, and if somebody says, well, I could use crypto, well, I can also use a real-time payment, and I can do it through a bank account, and I don't have to go in and out of crypto or have any risk of the fluctuations of crypto that can happen in a few seconds or a few minutes, and certainly overnight. I don't have that concern when I'm making real-time payments, which can settle within in less than 30 seconds. That the difference between the real-time payments and the instant payment rails that use ISO 20022 is that those instant payments are not just available immediately to the receiving party, but the banks are settling it simultaneously to that. So the risk for the banks in that case is less, as opposed to a bank failure where the funds are not, no longer there when they needed to settle overnight, or whatever the settlement period might take through ACH. So and it's also like push to card is another faster payment that we consider at the US Faster Payments Council, and the receiver of those funds gets those immediately, but the banks are net settling those through wires and ACHs as well.
This is amazing. Our hour has flown by. Austin, I know you're chomping at the bit to talk about stablecoin. We didn't get there. Dan, I'm sure you've got more to weigh in, but first I just want to thank you for this. And I see my friend Ron Mazursky came on camera, which is my signal that I need to wrap up this part of the evening. Ron?
Yeah, we have a couple of questions that came in. I just wanted to try to fit those in if possible. One from Lawrence Pruss. Given the recent failures of BaaS offerings, Cross River, for example, and the regulatory complexity, could we just see some of the larger fintechs apply for banking charters, especially if large fintechs are going to require similar oversights that banks have today, thanks to the CFPB? Anybody have any
I was going to say, as somebody who's literally been involved in that, I'll pile in for a moment. I think this relates to something I also think relates to what Steve was just talking about, and probably the single biggest area where I'm genuinely worried for the US banking system, which is that we need to fundamentally rethink some of the past decisions we have made to address some of these issues, because the Fed's antipathy towards anything that looks like a narrow bank, which is what a lot of the fintechs who hold money for payments look like, boxes them out of the banking system. But what that has caused them to do is build an entirely parallel 24/7 real-time payment system. So prior to this year, I agree with what Steve was saying about like the volatility of crypto, but let me tell you something that is literally existing right now. There is a stable coin called USDM. It's run out of Bermuda in a segregated accounts company holding only T-bills and overnight reverse repo as the reserves, bankruptcy remote, that is available on low-cost public blockchains, that is having payments apps built on it that can be used 24/7 for real-time global cross-border payments. That is a big problem for the current US system, a very big problem. And what is USDM? Essentially a narrow bank. So we have an opinion on that on shore, but the problem is the Eurodollar market has disagreed with us, and now we have a problem. So I would say on that fintech thing, when I was saying earlier, I think we need to rethink some first principles questions. Things like this are why. Things are moving much faster than we think. Like, guys, RTP has been the standard in Japan basically for 2 decades now, right? Like FedNow is just catching us up to the year 2000. And so I think sometimes here we don't appreciate how far and fast some of these things are moving, and I worry we're going to lose the plot.
Yeah, I would
Please go ahead.
I would add that, you know, several years ago, the OCC, to great fanfare, launched what it called the FinTech Charter, and absolutely no one applied for it. The banks that, or the fintechs that have applied to become banks, have either withdrawn those applications or they were rejected. There's a whole litany of reasons, but included in those important reasons is the antipathy of the bureaucrats inside the FDIC or the OCC, typically the FDIC, because they, you know, they see all new bank applications. They have an antipathy towards innovative business models, right? They've been doing this for 150 years. They like seeing a community bank that serves its community and makes real estate loans. That's all they know. And so you're an uphill battle if you're a fintech that wants to get a bank charter. If you should get approval, the management realizes what's required to be a bank and they back out, right? You've got to running a bank's a complex and challenging business in the best of circumstances, right? And so they pull out. So it's not a real option. For better or worse, fintechs are just going to have to find a bank to marry, right? To have a close long-term partnership with.
Yeah, and what I am worried about, to pile on there, is because this is not happening in other parts of the world, what we're actually going to have happen is that the payments industry in general moves outside of the US slowly over time.
And I'm with you. That's how I see the world too. I think these stable coins they're going to solve the whole payments problem, right? There is no reason that you can have an instant global payments network and blow the card networks out of the water. It needs to happen. It's where it's going to happen.
I'd like to weigh in just a moment here, because I didn't get to talk about an important subject to me. Is I feel that the banks, the writing's on the wall. They got to see it, because if they don't, they're going to be in the rearview mirror. And if they don't necessarily need or want a CDBC, but the federal government could help engage the banks into an intermediated equivalent of a CDBC, that the funds are held at the Federal Reserve, but the Federal Reserve is not an operator of it. The Federal Reserve just oversees it, just like they do the existing banking environment. And you can call it bank issued stable coins, or a more recent term is tokenized deposits. And it's actually something I envisioned back in 2017, and filed a patent for it back then, that I just recently gotten in last November. That is kind of what I say. It's the lifeline for the banks to wake up and join together to act like a non-bank and act like a fintech, and save the banking ecosystem we have today in the US.
You're going to need some
Well,
radical changes in balance sheets for that to work, though, because SVB is the cautionary tale of doing that with banks.
So I'm just going to sneak in one last question. Sorry about that, Austin. Tom Lehman put in a question, and maybe this is interesting to some of you. Will patents for innovative or creative be viable in the world of expanded AI capabilities? I think it opens up a whole can of worms.
Sorry, can you repeat the question?
Will patents for innovative or creative be viable in the world of expanded AI capabilities? And Tom, if you want to turn your mic on and explain it further, that's fine.
Sure, thanks. I didn't word it very well, but the bottom line is everybody talks about AI and how it's potentially coming up with its own innovative way of capturing a lot of information and techniques and things that are in the public domain, shall we say. And that in and of itself could be considered maybe creative work that might be patentable. Or worse, on the negative side, is if you've got some kind of copyright or patent and AI picks it up and doesn't attribute it or pay fees for it, for the patent, what does that do to patents? Does it just, in my opinion, eliminate the need for a patent office altogether? That's really kind of the question. It's a heavy question. I have no answer.
Well, I'm
Maybe
going to
we'll-
stay out of. I'm going to stay out of this one as a non-lawyer, so I punt.
I mean, it's on the edge of what Open GBT or whatever Open AI was all about with its nonprofit, trying to protect the world from the maluse of AI. Well, I'm thinking more positively, thinking more about, well, what's the creative side of it, and how does that help? You gave some great examples of use cases. Well, who gets the rights to hold that, and do any royalties get paid ever again? That's really kind of the question. We don't have
Ron,
to
we might
answer
have
the
another
question. It's just
topic.
out there for maybe another session.
Yeah, that's where I was thinking.
So
It's a fascinating question.
I think I'm going to try to wrap this up now. Ed, thank you for putting together a great panel, and thank you to our panelists, Austin, Dan, and Steve. Appreciate your insights. You guys have such great expertise in different areas, and really made this worth listening to. I want to highlight that in our meeting chat, there's a number of other notes that people have put in with links to articles, etc., that you might want to see. So I'd go to the three dots on the bottom, click on your chat button, go to the three dots on the bottom of the screen, and hit the save chat feature. and you can save what people have suggested you take a look at. Now, before we go into our networking session, I just want to let you know about some of our NYPAY's upcoming events. Next month on February 20th, we're going to have where investors are placing their fintech bets for 2024. And we have investors that will speak about what they are thinking about, what they are seeing out there this year, obviously changes from last year. And after that, based upon recent member research that we sent out, we've heard back from our members, and some of the upcoming sessions will be embedded finance. How can embedded finance enhance business banking services for SMBs? Regarding cross-border payments, is real-time payments the next step? And 3, ISO 20022 is a new messaging format, really a big deal for bankers and payment providers. So I think we've got some really good, interesting sessions coming up in the next several months.